Hello, my name is Haziq Razali. So I'm going to present about a night case study where we have chosen one out of three for our group assignment project. So little bit of background about night case study is that it discuss about a portfolio manager who works at North Point named Kimmy Ford, who is trying to decide whether to buy or not the night stock. Based on the report, Nike had a negative year which led in a severe decline in sales growth, decline in profit, and also decline in the market share due to supply chain issue, and it was an adverse effect of a strong dollar. Kimmy Ford has been assessed by her assistant Joanna Cohen, where she has come out with her analysis about Nike incorporation. We have some agreement and disagreement in Joanna's analysis, and uh, what we agree based on Joanna analysis is first, we agree that Nike share similar risks to only warrant one WAC computation only. And second, Cool Hunt, which is the subsidiary of Nike, uh, have a different risk, but it represents only such a small fraction of total revenue of Nike Incorporation. So we do not need to compute a different WAC for Nike total WAC competition. And we also agree on the tax rate used, which is 38%. 38%. The reason behind this is that U.S. statutory rate 35%, and by adding up the average of 9 state taxes around 2.5 to 3.5%, we get a tax rate of 38%. And however, we have some disagreement, such as the cost of debt. The computation of Joanna Cohen using interest expenses for the past years is incorrect for us because the purpose of WAC is to calculate, and the purpose of WAC calculation is to determine the cost of a new project. And by using interest expenses for the past year is an accurate representation of the company's cost of debt. Uh, She also used a weight of debt using book value rather than the market value. We know that book value is the price paid for an asset that will never change as long as you own the asset. Therefore, she did a mistake by using historical data in estimating the cost of debt, whereas it is a must for her to use the market value. Based on the current data, the reason behind the decision is show how much it will cost the firm to raise the capital today. Second disagreement that we had is a disagree on her taking a Nike's average beta. Joanna Cohen's taking average beta for Nike as to be used for the current beta. This is quite inaccurate because we found that current data does not represent the future systematic risk. So we suggest that we use the most recent beta. Okay, so our computation, our wet computation is we get 9.264%, whereas from Joanna Cohen it's around 8.4%. Therefore, Kimi Ford should, based on the WACC calculation, it represents that the share price of Nike is $58.13 rather than its market price currently trading at $42.09. It is a 1.38% times higher than the market price. So this shows that Nike is undervalued. And also, current growth is about 6 to 7%. It's much lower than one estimated, which was 9.27%, which is majorly understated. Nike also has changed their business technique by focusing on mid-price segment, which for a long time was less concentrated. This means that there is a possibility for their sales total increase that they will lead to an increase in revenue and profit. And in addition to the Nike share price and dividend will be increased in the long term. Based on this record, we recommend to the North Point that large Kimmy Ford should buy Nike share because it is currently undervalued and it has major growth potential that will be beneficial to the fund. In addition, the goals that were set by the management of Nike Incorporation should be a great source of profit. Also, by the past performance of Nike Incorporation share against the market index, technical analysis support the buy decision. The past performance shows that Nike can outperform the current market returns, and now that it has gone down and left with the hope for an increase in the best based on the plans being set up. And our conclusion is that before buying Nike Incorporation, Kimmy Ford must decide whether she wants share for a long term or for a short term. If it is for long term, then the decision is to invest is a good one, and if it's for a short term, she should be cautious about the fast changing industry that the Nike is doing, and also changes in the footwear trends. However, based on the historical, recent and future data, the decision that Kimmy should be considered that is to buy Nike share. For this reason, that it's quite safe, currently undervalued, and also has a great potential.
Hi everyone, I'm Ricky. The second case study that our group has chosen is the company of American Greetings. American Greetings was the second largest greeting cards publisher in United States, with a record of revenue 1.7 billion in fiscal year 2011. In year 2011, the share price of American Greetings had been cut in half to a year-end closing price of $12.51 US. The management of American Greetings was facing a decision: either activate a 75 million for share repurchase program in the market or preserve cash for future needs. According to the valuation from the management, they come out a EBITDA multiple at 3.5 times. However, I don't think that this number is appropriate for American Greetings. The reason is because they didn't include the total cash in enterprise value. The formula of enterprise value should be market capitalization plus debts minus cash. After restructuring the formula, I come out a new ratio which is 3.08 times. If the EBITDA multiple of American Greetings is 3.5 times, we've calculated the industry average EBITDA multiple at 8.08 times. If the American Greetings was able to trade at an industry average EBITDA multiple of 8.08, the enterprise value of the company will be estimated at $1,587 US, and the estimated equity value of the company will be $352 US. This valuation would create an American Greetings implied share price of $35.28 US. To find the enterprise value of American Greetings and the corresponding share price, we had used the scenario analysis and the discounted cash flow model. But before that, we need to find out the discount rate for American Greetings. We were given that the American Greetings had a debt rating of BB+, and from Exhibit 6, we knew that the cost of debt is 5.8%. By using the CAPM model, we've calculated the cost of equity at 10.95% with a given beta 1.63 and the market risk premium of 5%. Then we calculate the discount rate using the WACC formula, and we get the discount rate at 8.49%. Before that, we mentioned that we had used the scenario analysis to find the corresponding share price. We used the scenario of during bullish market and also during the bearish market. During the bullish market, which is the best scenario, we get the present value of company at $1,222 US and a stock price of $25.64 US. However, in bearish market, which is the worst scenario, we get the company value at $830.25 US and a share price of 15.47 US dollar. In conclusion, we would strongly recommend American Cretins to enter the market with the 75 million to repurchase share because our analysis indicate that the share value based on the best and the worst scenario is currently undervalued by comparing the current market price was at 12.51 US dollar.
Hi, my name is Farah. So I will be presenting the case of JetBlue. So basically this case is about JetBlue Airways. It is a low-cost American airline company. So this is a case where JetBlue is to decide what to price their IPO. So the initial price is $22 to $24. However, the company is facing sizable excess demand of 5.5 million. So the management has increased the share price from $35 to $26. But still people think it is still low compared to the value of the company. So what we have done is an analysis of what share price is acceptable for JetBlue's IPO. So what is IPO? IPO, or initial public offerings, is a process where an unlisted company would want to go public and be recognized in the stock exchange. So the company wants to sell new securities to the public for the first time. However, there are some advantages and some disadvantages. So the first advantage of going public is raising resources for the issuer, and it will improve stakeholder trust because by going public it brings a positive effect to the organization on its stakeholder by introducing best business practices and improving the opportunity to hire more workers. Furthermore, it is expected to have access to more capital markets for potential funding needs. However, there are also some disadvantages of IPO. Firstly, it is very costly and timely for the company to process the whole thing. It includes the legal and accounting services, filing services, and expense allowance for the underwriter. It also can be an extremely difficult process for the registration, and another downside is they have to work with the audit from public operations because once they go public, the information has to be shared to the public, and it is must be comply with the provisions under the 1934 Exchange Act. So the compliance with the reporting standards could be a bit costly. So what we did for the comparable companies approaches is the first method is the price earnings multiple. So this method is useful in determining the correlation between the company's stock price and the earnings per share (EPS). So in increasing the PE multiple, we can compare with the competitors' PE from the same industry. There are two types of PE multiple. The first, trailing and leading. Trailing is known by using the previous periods of EPS, and leading is based on the future estimates of EPS. By using trailing and previous figures, we calculated the share price to be $28. As for leading, we forecasted the EPS in 2002 to be $1.2 and finalized the share price of $34. There is a big difference between the trailing and the leading because of the increased price earning ratios in 2002 for low cost carrier and because of the strengthening of JetBlue's EPS. So the second method is total capital multiple. To deduce the price per share using total capital multiple, we calculated the book equity per share and the book debt per share. We used the median for the total capital multiple and perceived a valuation of $37. Thirdly is the EBIT multiple. We used the average to calculate the EBIT multiple. So the outcome for trailing is $19 and the leading is $29. There was a vast difference because of the increase in EBIT in 2002. Lastly is this discounted cash flow. We derived a WACC of 9.51% and the figure derived is $30 per share.
Hi everyone, now I'm going to talk about the financial forecast for the JetBlue airline. From Exhibition 13, we found that the forecast revenue for JetBlue is changing from 320 million to 2,912 million from year 2002 to year 2010, where the growth rate was in a decreasing trend for 87% to 8%. Besides, we also found that the forecast number of aircraft increased from 21 units to 117 units from year 2002 to 2010 due to JetBlue expand their business after they issue IPO to the public. Due to the increase in the aircraft, the fixed asset value also increased from 513 million to 2,568 million. Depreciation expenses and capital expenditure also shown in an increasing trend from year 2002 to year 2010. From the forecast trend shown above, we see the financial forecast of JetBlue is actually reasonable based on some key assumptions. First, the exhibition 8 shown the revenue growth rate of Southeast Airline. Actually, is a competitor for the JetBlue. Is also raising 50% after they are going public and remain at around 15% at the subsequent year. We had used Southwest Airline WACC as a proxy discount rate, as Southwest provide the close proxy to JetBlue due to its duplication of practice, that is low fare airline. From the calculation above, we obtain 5.22% of after-tax cost of debt, 8.06% cost of preferred stock, and 11.15% cost of common stock. Then we multiple with weighted average 0.26, 0.71 and 0.03 respectively. We driven a WACC of 9.81%. In acquiring the WACC, there was an adjustment of 0.5% in the pre-tax cost of debt, and it caused the changes in share price. By using the discount cash flow model, we get the share price of 30 ringgit and 04 per share. Compared to the other valuation, the discount cash flow share price is higher than total capital multiple and the EBIT multiple, but it still remain within the range of price per equity multiple, which is between 28 to 34. In conclusion, JetBlue should have an IPO share price between the range of 27 to 30 ringgit. The range is within all the multiples and discount cash flow estimate. Thus, the current suggest price of 25 to 26 actually is too low for the actual value of the company. That's all from me. Thank you.